Okay. First of all, if we have some problems with the connections here tonight, earlier today I was having difficulty. My son's internet was going in and out here, and I was concerned about what would happen during this session. So all I can say is if we get cut off, stand by, and I'll try to get back in. And if it becomes too bad, we'll obviously just have to probably give up on things, but hopefully that won't happen. Secondly, the homework that you submitted for chapters 13 and 15 was due yesterday. The only thing I want to say is I doubt that I'm going to get a chance to look at that before I get back home. So the beginning of next week before I'll be able to go through that homework submittal. The midterm is due tomorrow. I know, Betty, you've done your 2 parts. Earlier, Maureen, you had done one.
I just finished the other one
okay.
20 minutes ago.
All right. Well, I was online about an hour or two ago looking to see where we were. The one thing, obviously, I'm sure you recognize by now, I'd intended to set that up so that the points reported out would reflect the fact that each of those questions in the 2 tests would have 2 points each, but for some reason I missed the toggle where I could change the points, and so it was only showing 1 point per question. I don't know, since I haven't gotten a chance to see much of the results across, the small sample of the whole class here, how it came, how it's going to work out for us. But I guess I just have to defer any comments until perhaps next week on that. Today, you may have seen I posted our second case, the Stevenson real estate case that's at the end of chapter 16, and hopefully you recognize that you also saw that I asked you to use the data and the perspective provided in the text, but I gave it my own set of questions or answers that I was looking for from you. So don't use the textbook's list of questions in preparing the case. Use instead the Word file that I posted with it. Uh-oh, did I lose? Are you guys hearing me?
Yeah.
Yes,
Okay.
You cut out for a few seconds.
Yeah, it just froze up there for a bit, and I thought I might have had one of those interruptions I feared. But anyway, make sure you address the questions that are contained in the Word file that I posted for that case. And of course, I also provided an Excel template that I try to lead you through step by step for that case, so that it's somewhat similar to what I did with the last case. But I want to emphasize to everyone that, and I put this in the instructions, that I want to have the logic or the math calculations that you use in the Excel spreadsheet built into the cells rather than just pasting in numbers. Generally, you've been doing that on the cases, but I still had some situations where people are just typing in numbers, pasting in numbers that were calculated elsewhere, and that makes it very hard for me to grade those. So anyway, along the lines of an item that hopefully you won't be too disappointed about, is that I decided we probably don't have the time to do a second discussion topic, the forum. I would like to do it. It was my intent to do it, but as I looked at the nominal 2 weeks that we've got left here, and with the case, the midterm, and then a final, and all that, I just didn't feel that, and I didn't want to have you working on a discussion topic on Thanksgiving Day. So I just decided, unless somebody objects vehemently, that we'll probably scrub that second topic, and I'll just have to figure out how I manage the time better in the future. Okay. Any comments on that? Any
No,
disappointment?
thank you.
Severe disappointment? No severe disappointment, or I'm not going to run to the dean and complain about me violating the
No.
syllabus or anything? Okay.
No.
Okay. Back to just one last comment on the case. Again, like as with the homework problems, if you really are drawing a blank on some parts of that case, fire me an email and try to get some guidance. Again, my ability to give you feedback between now and next Monday is going to be a little bit limited, but I'll do my best. But certainly, I'm willing to give you some additional guidance beyond what the instructions provide for getting started on that case. Any questions on homework problems? The last assignment in particular, I haven't looked at them, so I don't know how they went down with everybody, but are there any open questions?
Nice.
What's that?
They were short.
Yeah. Yeah.
Yeah, I did particularly on chapter 15, I guess it was. It was a fairly short list, but I just want to make. Go ahead.
Chapter 13, number 4, where we talked about assuming the CAPM or one-factor model holds. I use the CAPM equation to do that, but I was thrown with the return to the company's debt at 70%. I didn't know where that fit in at all.
Okay, which problem was that?
Number 4 on chapter 13.
Let me take a quick look at that so I refresh myself. Well, okay, so you're asking how would the 7% return on debt come into that calculation?
Yeah.
It doesn't.
Okay. All right. So I just ignored it because I thought I don't think it has any impact on it.
Yeah.
Okay. All right.
There will be those situations where you'll be given some extra data that you don't need to solve a particular problem. That's an example.
Okay. All right. That's good. That's what I thought.
Okay. All right. Anything else?
Now, I just with that question number 3, I realized what I was doing wrong, and if we went by my math, we'd get something different, which is what I was doing. I completely forgot an algebra.
Okay, that was.
I figured it out.
That was the one you sent me the email on?
Yeah.
Okay.
Yep.
Okay.
Yeah, I had to dig back in the memory for that one. Yeah.
Well, hey.
That was basic algebra.
If you think reaching back in memory is hard for you, think about my situation. So, anyway. Okay. Well, looking ahead for the next week, it's obviously the normal complement of 2 chapters. There are 2 video lecture segments that the second one in particular is for chapter 17 is a bit long. It's not real full of heavy duty material. I guess in my view, at least not a lot of formulas or anything, but there's a lot of qualitative perspectives provided in chapter 17. So if it's possible, I would recommend consider breaking your review of that video up into 2 nominal 30 to 40 minute sessions if you have that luxury. In addition to the normal things, again, the homework problems, there's only 4 problems out of chapter 17, and they're actually 2 sets of 2 problems that sort of parallel each other, which will become clear when you look at that. But in other words, there's 2 problems followed by 2 more problems that are similar to the first 2 with just a little bit different spin on them. So again, the chapter 17 homework assignment is pretty brief as well. And of course, getting a start to the extent you can on that our second case, which I forgot to mention before, that you see in the assignment. I'm going to ask it to be due on the 1st of December, which is the Monday after the Thanksgiving weekend. So that's it on that. Now, just making a few comments on these next two chapters, which are both related to the capital structure decision. That is one of the most fundamental financial management decisions that a firm has to make. Decision about where to source the capital to finance itself. Chapter 16 is called Basic Concepts, and what it really does in that chapter is introduces the foundation of the work that's been done in this field over the last 40 or 50 years, and also provides the basis for understanding what is it that would constitute an optimal capital structure. And so, make sure as you get through that chapter that you understand when we say a firm is seeking an optimal capital structure, just what would that entail? And the short answer to that is it's the capital structure that would maximize the value of the firm and or synonymously minimize the firm's weighted average cost of capital. So that's what we mean by an optimal capital structure. Again, the term and the concept surrounding the use of financial leverage is introduced. We dealt with that in some prior chapters. So make sure you understand what we mean by financial leverage, not just the use of debt, but also, of course, technically, the use of preferred stock is also a form of fixed cost financing that would introduce financial leverage into a firm's capital structure. So as we address Chapter 16, we're trying to get at the fundamental question of whether capital structure or an optimal capital structure can really influence and maximize the value of the firm. And there's a few slides in there that address the traditional accounting view of this leverage decision. That is what's referred to as an earnings per share versus EBIT, or return on equity versus EBIT analysis. And it's instructive to understand that accounting perspective, but the one big thing that the accounting perspective doesn't provide to us is an inclusion of, or a consideration of, what happens to the risk of the common stock and even the debt as a firm employs more and more leverage. So for that reason, the accounting view of the leverage decision has always been viewed as somewhat deficient, and it doesn't allow us to get at the question of, are we really creating value or destroying value by using more debt? This chapter brings us back to, I think we've been introduced to them before, but Miller Modigliani, or M&M as we in shorthand refer to them. Miller Modigliani did the foundation work in this area back decades and decades ago, and again, they were remarkably good at simplifying some of these key financial management issues. And it's if you look at how they developed their logic on this issue, it's to me it's quite impressive. Anyway, the point I wanted to make about the M&M analysis is, not to worry about trying to memorize the steps of their analysis or even the formula surrounding them, but to try to step back and understand the rationale or the logic that leads to the conclusions that they reach with regard to the use of debt in a no-tax world versus the one in a world with corporate taxes. So, they're going to first develop the simplest case, which is a world with no taxes, reach their conclusions about whether the use of debt increases the value of the firm or not in that context. And of course, the headline there is that no, it does not. In a world with no taxes, it shouldn't make any difference how a firm chooses to finance itself. But then they move on to relax that assumption and introduce the presence of corporate taxes. And in that case, they conclude that indeed the use of debt does contribute value by basically increasing the after-tax cash flows that a firm will generate because of the tax deductibility of interest. The key thing to keep in mind, however, is that that analysis, as it's presented in Chapter 16, right up to the end of Chapter 16, still does not consider the very important issue of what about the increasing possibility that a firm will enter financial distress or encounter financial distress if it uses an excessive amount of debt. In other words, the issue of, or the assumption by Miller Modigliani that that there's zero cost associated with financial distress, which was a simplifying assumption and one that was still not fully relaxed by the end of Chapter 16. Particularly call your attention to the summary slides. I think they're slides 30 and 31 that summarize the no tax case in the case of slide 30 and the with taxes case in the case of slide 31. So, make sure you look at those summary slides and say, yeah, okay, now I understand the key points being made here, because that's a pretty good sort of walk-away point from Chapter 16. Do you understand the basic principle of capital structure decision? I mean, is that, I use the term a lot, the capital structure decision or optimal capital structure. Do you understand what it is fundamentally we're trying to address in this issue?
I think it's, and I don't know if I'm right or not, but I think it's whether the incurring debt will increase the value to stockholders of the firm. If the value of the firm is increased to stockholders by incurring debt and rationalizing that debt can be paid back, then if that maximizes the value of the firm, then that's a good thing.
Well, yeah, maximizing the value of the firm is, of course, our overriding goal in financial management. But the way to think about it is, for a given company and with a given size of an asset base, in other words, given amount of capital, a company needs $10 million to finance itself. Should it be 100% common equity, or should it be 50% common equity and 50% debt? And you can think about it as, if a firm starts out with 100% common equity, would they generate value just by borrowing money and buying back shares? In other words, that move to leverage up their capital structure would be done by borrowing money and taking that money to replace common stock.
So the buyback then.
That's the structure, I think, that makes it the easiest to understand what we're trying to address here. Is if we package the firm as 100% equity, we have one value. We call that the value of the unleveraged firm. Mm-hmm. And then if we repackage it by replacing 50% or some percent of the common equity with borrowed money, would we all of a sudden have an enterprise that's worth more? Okay, and so and keep in mind, behind the scenes there of that question is the fact that equity capital, including retained earnings, very important point, including retained earnings, equity capital is expensive. Mm-hmm. The investors in common stock universally look for higher rates of return than investors in bonds or investors in the debt of the same company. So those expectations or requirements on the part of the suppliers of capital become the cost of capital to the firm. So when you're replacing common equity with borrowed funds, which on an after-tax basis especially is much cheaper, much lower required return, directionally you would seem to be driving down the cost of capital. If you can replace expensive dollars with cheaper dollars, your weighted average cost of capital should go down. The key thing you got to keep in mind or take into account is what are you doing to the risk? As you bring in the debt, the remaining smaller base of common stock equity is bearing more and more of the risk. You know, there's a total risk package that has to be borne by somebody or a given company. As you know, if you have 100% equity, you have a lot of equity dollars in there to absorb proportionally smaller amounts of the total risk per dollar of capital. As you introduce debt, the debt holders don't bear risk to a significant degree. That's not what they're paid for. That's why they accept a lower rate of return. Debt holders expect to be paid. And if you don't pay them as promised, you got a big problem. You're in default. So debt holders don't absorb a lot of risk, which means that the total risk package now has to be borne by a smaller and smaller base of common stock equity capital, which means that each dollar of equity capital becomes more risky as an investment in that now leveraged up firm. You see that point?
Mm-hmm.
Makes sense?
Yeah.
So you can think of it as, are we creating value? And sort of like the flip side of that is, what are we doing to our cost of capital? If the cost of equity capital in particular that's remaining as you increase the leverage in your capital structure, as that risk rises, as long as the increase in that risk is modest as compared to the value that you're bringing through the tax deductibility of interest and the lower tax bill, therefore, that you have as you employ more debt, then you're making positive progress toward your goal of maximizing the value of the firm. If you get to a point where the total negatives associated with bringing in more debt exceed the value of the incremental tax savings, then you've passed that point of the optimum. You've gone to a point where now the negatives are outweighing the positives, and you're going to lose ground in your objective of maximizing the value of the firm. So just sort of keep that perspective in the back of your mind as you get through that. Now, Chapter 17 continues the capital structure decision or issue, but it looks at some of the limits on the use of debt. And this will include both, things like bringing bankruptcy costs into the picture and seeing what effect that has. And also looks at, well, how do firms appear to behave? Firms in the real world appear to behave as if they're following the concepts laid out by Miller and Modigliani, that is, a belief in an optimal capital structure. And toward the end of this chapter, the authors provide some evidence. It's not a hard and fast case, but it's indicative of the way firms seem to behave in light of what we believe about the capital structure decision. This chapter, sort of in the first half of it, gets into several examples also of what we call dysfunctional incentives created by the use of debt. Dysfunctional incentives created that would lead perhaps the management of the firm or the shareholders to do things that would be not viewed as totally rational, or at least not in the best interest of the firm in total, including the debt holders. And those include the example of taking excessive risks, which is sort of pursuing negative net present value projects because it's beneficial. It gives a chance of a big win to the shareholders, but from the total company perspective, is just the wrong thing to do. And the example cites accepting negative net present value projects, which we know is a bad management decision, but yet in certain circumstances, when a firm is very close to a condition of financial distress, those home runs may be the only thing that can save the common stockholder. The common stockholders at that point need a home run. Otherwise, they're going to end up with a worthless investment in this firm. And so you take on a negative net present value project because there's some slim chance that that project will in fact sort of pull a win out of the fire for the common stockholder. Second of these dysfunctional incentives is the underinvestment, and it talks about the fact that again, firms may be inclined not to accept good investments because the primary beneficiary will be the bondholders. And if the people making the decision are the shareholders or the shareholders' representatives, that is the management, they may choose not to do the right thing for the firm, not to undertake certain investments because they don't see a gain for them as shareholders. They see the preponderance of the benefit going to bondholders, and that's what we classify as the underinvestment scenario. Now, I noticed in reviewing this video, and I'll just call it to your attention now, it'd probably slide by you without noticing it, but I picked it up, and it's one I've got to consider going back and re-editing. On slide 13, in discussing this underinvestment scenario, there's a proposed project that's shown to be a winner for bondholders. But in my commentary, as I go through that, I say you can see that this investment would not necessarily be a winner for the bondholders, and that really was not the correct interpretation of that. So on slide 13, when I say bondholders would not clearly win by pursuing this project, the numbers you'll see there would suggest that the bondholders, in fact, will win. They will have the value of their claim increase from $200 to $273 in that scenario. So just may want to make a note of yourself in the event that as you listen to that part of the video, you say, why is he saying that? That appears to be contradictory to what I'm seeing on the slide. In fact, it is. I don't know why I did that, but as I viewed it this time, I even went back and replayed it and said, did I really say that? Indeed, I did. So it was. I'd made a mistake once before in my life. It's only the second time. And finally, the third of these dysfunctional situations is called the liquidating dividends, or liquidating the company out from under bondholders. And as I noted in the video, bondholders are pretty smart, and they do protect their interests. And normally, the ability of a company to liquidate the company out from under the claims of the bondholders are pretty much blocked off by provisions in the bond indentures. Bondholders build in protections for themselves in the structuring of those bonds, and so it's pretty difficult for a company to do that, at least a large publicly held company with publicly held debt. Smaller companies can do things like that would work against the interest of creditors, because creditors don't always have those kind of protections in place. But I think the first of these three, taking excessive risks, playing bet your business because that's the only way you can come away with something positive in the way of residual value for common stockholders, is a realistic situation. Okay, this situation I described before of trying to find that optimal capital structure, trading off the tax benefits of using more debt against the increasing risk of incurring financial distress, is what's called the trade-off principle in this area. The trade-off being the trade-off between tax benefits and increasing and at a certain point an inordinate amount of risk associated with using more debt. There's also a discussion in this chapter about a number of facets of game theory, and you guys got into game theory in your managerial economics course, right?
Yes.
So you get some sense of what game theory is all about, where you've got to anticipate what the reaction of the other party will be to something you do, and then you shape your decision based on what you think the other party is going to do in reaction to you. So in this area, this capital structure area, there's also some of that at work. There's a discussion of something called signaling, which refers to the market's interpretation of a firm's announcement about how it intends to raise capital to finance a particular investment. And, it pretty much boils down to, well, if a firm believes that its stock is overvalued, it's going to issue new stock. If it believes that the stock is undervalued, which would of course be a good buy, then it would issue debt. So markets, as I note here in this video a number of times, financial markets don't like an established company issuing new common stock. And you'll seldom see established publicly owned companies doing secondary offerings of new shares of stock, because the markets almost universally react negatively to it, just as they have a knee-jerk reaction to a firm announcing their intended acquisition of another firm. In that case, 99% of the time, the price of stock of the acquiring company goes down, and the price of the to-be acquired company goes up. And that's indicative of the view that companies typically pay too much for acquisitions. And so that's another form of signaling. But in this case, we're talking about the market trying to say, well, if they're going to try to raise new equity capital, that must mean they believe that capital is attractively priced to them, the firm, which means it's unattractively priced to us as investors. There's also an interesting discussion, and maybe hopefully you follow it as you get through it, called the agency cost of equity. And it's kind of interesting when you read it, this description, because what it basically says is that, maybe it's good to use debt to tie the hands of management, tie the hands of the CEO and the CFO in trying to prevent their wasting shareholder money by doing foolish things with it. So in other words, if we constrain executives by imposing fixed costs on them, interest payments that they must meet, or even dividend payments that they would be reluctant to suspend, you basically take the money out of their hands, because executives are like kids. You give them money, they're likely to do foolish things with it. It's kind of ironic that that's a prevailing view in finance and in the markets, but the fact of the matter is, again, the track record of companies making acquisitions has been pretty poor. I think it's safe to say that the majority, if not the vast majority, of acquisitions the corporations make end up being bad investments for the shareholders. In other words, it's a bad use of shareholder wealth to go out and pay a premium for a company so that you can just bring it into your corporate portfolio. What have you really achieved by paying more than what the market said that firm was worth last week by acquiring them this week? And so that's what this agency cost of equity is all about, that using debt right up close to the point of optimal capital structure prevents management from doing foolish things with cash that they would otherwise have available if they didn't have to make those debt payments. Finally, there's a discussion of what's called the pecking order theory, and that this really gets at one of the observations about how firms really appear to behave. And that's, as the pecking order says, firms first will use internally generated capital, which is retained earnings. And secondly, if they need more capital, then they'll use debt. And third, will only issue new stock as a last resort if they absolutely are out of access to capital through the other options. And this pecking order theory, on the one hand, sort of sounds intuitively obvious, like why go out and incur the cost of raising new capital externally if you've got internal cash flow? And secondly, given what we've said above about the market's reaction to issuing new common stock, it's not surprising that firms would treat new common stock as their last resort source of capital. But on the other hand, this theory sort of contradicts the whole concept of there being an optimal capital structure, because there will be points in time where the right thing to do is to bring more common equity into the firm's capital base in order to maintain yourself near that optimal capital structure. And you shouldn't be deterred in the short run by how the market will react if you truly believe that you'll achieve lower weighted average cost of capital by sticking with that or sticking close to that optimal capital structure. So again, those are just some background perspectives. You can hear the treatment in the videos, and of course also review the treatment of it in the textbook. Now, as we've moved from Miller Modigliani's world of no taxes, perfect capital markets, and so forth, and then introduced the use of the existence of taxes, the first step was to introduce just corporate taxes, corporate income taxes. But after Miller Modigliani's work was done and people had hashed over that for a while, people said, well, what about personal taxes and taxes imposed on investors, in particular on stockholders? Could that possibly change our conclusions about the benefits of using debt and pursuing the tax advantages of debt interest deductibility? The bottom line on this is that Merton Miller, half of the M&M team, did some later work, and what he came up with a more sophisticated view that takes into account not only corporate income taxes, but also the tax rates being applied to interest income versus income derived from common stock investing. And the general conclusion of that is that when you consider personal tax rates at the levels that we typically see them in our tax system, it reduces the benefit from the use of debt from what was suggested by Miller Modigliani's work. It suggests that instead of each additional dollar of debt being worth 40 cents in terms of firm value, maybe it's more like 25 cents. So it doesn't change the direction of the conclusions, but it changes the magnitude of the benefit, if you will, for the use of debt. And so that's the main message to take away there, is say, well, corporate taxes aren't the end of the story. There's also to be considered what is the effect of taxes on dividend income and capital gains income and interest income at the level of the investor or the supplier of capital. And then I think the chapter wraps up with a discussion, as I said, alluded to earlier, of observations about how do firms really behave relative to this capital structure issue. And the first thing you'll see in there is that at least U.S. firms use less debt, or appear to use less debt, than the theories would suggest would be optimal. In other words, it appears that they're not fully accepting the fact that there's this significant advantage to using debt up to the level of optimal capital structure. And I say U.S. firms because, in fact, you examine patterns around the world, there are certain countries where, for example, Japan, where firms have traditionally used higher levels of debt than U.S. firms have. But one of the reasons for that, first of all, you'd think, well, it ought to be dependent upon what level of tax rates they're facing. And, like right now, the U.S. is the highest in terms of statutory tax rate. Back to our discussion topic, and we talk about inversions. The U.S. is right there at the top of statutory corporate tax rates, which would suggest that the value of the use of debt is greater for U.S. firms than it is for, let's say, most European firms. And yet we see them not appearing to fully exploit that value, latent value that would lie in the use of more debt. when we consider, the pecking order theory and how the firms seem to behave relative to that, it points out that indeed firms do seem to want to use internally generated capital as the first choice, and certainly new equity capital from new common stock sales as a last resort, as we discussed earlier. I think, though, what's missing in the book's treatment of this is the fact that, many, if not most, large firms today, with few exceptions, generate pretty high levels of free cash flow. These firms today, maybe because they're in a slow growth environment, they've got high levels of free cash flow relative to their need for investment. And so they may not need more debt capital. But that also suggests they're willing to let themselves drift down in terms of their debt to equity ratios, drift down from what otherwise might be the optimal, a point where they can minimize the weighted average cost of capital. So, it's kind of interesting to ask, well, why aren't firms? This seems to be easy pickings. When you think about how do you create shareholder value? Well, there's the old-fashioned way. You go out and you invent new products, and you do a lot of good marketing research, and you do a lot of good product design work, and do all the things necessary to make money the old-fashioned way and create value through higher returns on capital. But if there's an alternative where you simply go out and replace your equity capital with debt capital, and voila, you do the same thing as you would achieve if you successfully did it the old-fashioned way, why don't firms pursue that? And there's no clear answer on this. This whole issue of capital structure decision is a highly subjective one. But the one thing that I believe is that behind a lot of what's observed here about firms not using as much debt as we think they should is that firms are underinvesting. Firms just aren't investing in themselves at the rate that they could and maybe should. So if you combine high free cash flow, firms generating a lot of cash, and being reluctant to undertake investment, it's not surprising that they're not out there seeking to raise a lot of debt capital. And what debt capital they do raise is not going into gross new investment, it's going into share repurchase programs. And at the end of the notes I posted, I said, what factors could lead to or make firms inclined to underinvest in themselves? What is it? Can you think of any reasons why firms would be sort of reluctant to take the steps to invest to the optimal level in their business? There's no right or wrong answer to this, but it's, directionally, what kinds of things would cause firms to underinvest?
Well, there's risk involved in debt. So if you're using your free cash flow, and not using debt, then there's no risk.
Okay, okay. Let me make sure I understood what you said and restate it. So you're saying it's safer to use the internal financing from free cash flow rather than taking on debt.
Right.
Right. And but there you're again sort of mixing the investment decision and the financing decision together. And we like to believe in finance. We separate those decisions. We say, what are the good investment opportunities in front of us? Decide which of those we're going to pursue, and then decide what's the optimal way to raise the capital necessary to make them happen. I would agree with you that certainly for management, it feels safer to use retained earnings than it is to go out and borrow capital. But in doing so, you're basically saying, then I don't believe there's an optimal capital structure. I don't believe that I get a lower cost of capital by having the right mix of debt and equity, which is, of course, what these two chapters are all about. And maybe firms behave in a way that suggests they don't believe that there's a significant difference, at least in their cost of capital, by using more or less debt. You think of anything else that would cause firms to want to underinvest? And this is sort of a pet peeve of mine. Pet peeve is too strong a term, but this is one of my hunches, is that American workers, one of the reasons American workers' salaries and wages have stagnated in recent decades is because companies are not investing enough, because capital is what allows workers to be more productive. And higher productivity is what creates the wealth from which labor can get higher wages.
So what you're saying is companies have become complacent.
Well, it's complacent, or they've become excessively risk averse is another way to say it. And to me, one of the consequences of that is that, again, American workers are being shortchanged in terms of the amount of capital they have available to work with and to make them more competitive in a global economy and deliver the kind of productivity gains that are the stuff from which higher wages flow. You know, if workers aren't more productive, companies aren't going to pay them more. You know, workers don't like to think about companies requiring them to work harder, but really the way to look at it is companies should facilitate workers being more productive by giving them more tools, i.e. capital, to make them more productive. The only way we can compete with, you know, $1 a day labor in Vietnam is by our workers being more productive. And of course, doing different things than what they're doing in Vietnam. We're not going to be assembling sneakers. We're going to be creating, you know, software packages or whatever. But the whole idea is the way productivity comes about is by workers having more capital to work with. So there's one other factor that, in relation to this rhetorical question I asked about what factors could make this underinvestment occur. The other thing is that our stock market, unfortunately, are dominated by security analysts who view capital investment as being risky. They would prefer companies to invest less because then they're less likely to make a mistake. Well, you know, like anything else in life, if you lead your life so as to not make any mistakes, you're probably not going to make a lot of advances either. And the same thing is true, I think, of corporate America, where they've been disciplined by the markets to want to keep their capital investments to a minimum. And as a result, these other chain of events happen. Workers don't get the capital they should have. The economy doesn't grow as fast as it should. Wages don't grow as fast as they should. And it's a vicious cycle. So this underinvesting, this potential underinvesting scenario is one that the book doesn't necessarily address in this chapter, or at least under this topic, but I think it's linked. And it gets back to the issue, what we're really trying to understand here is, why is it that firms don't seem to use as much debt capital as we think they should in order to achieve the lowest weighted average cost of capital? And maybe it starts with the fact that as long as they're not investing, they don't see the need to bring in new debt just to rebalance the capital structure. They're not inclined to bring in new debt just to balance the capital structure back toward that optimum if they're not investing in total. And so, you know, there's some implications of this that are sort of spread out. But I think the overall takeaway from Chapter 17 is, first of all, to understand how this financial distress or bankruptcy costs sort of change or temper the conclusions of the Miller-Modigliani analysis from Chapter 16. Second, to recognize that once you bring debt in the capital structure, you set up this sort of natural competitiveness, rivalry between bondholders and stockholders that sometimes can lead to irrational behavior on the part of management and firms in general. And finally, you know, again, thinking through some of these observations about how firms really behave, you know, would we be better off moving in the direction, from a capital structure perspective, that Japanese industries have traditionally followed? See, Japanese industries have typically used more debt. You take companies in the same types of industries in Japan versus in the U.S. Traditionally, the Japanese companies have used more debt. But the reason people believe that they use more debt is because in Japan, you've had a different relationship between banks and industrial corporations. In Japan, you've probably heard of the big Japanese corporate families. They were called zaibatsus back in World War II, but the Mitsubishis, Mitsuis, Sumitomos, there were these big families of corporations, and within each of those families, there was at least one big bank, Sumitomo Bank, Mitsubishi Bank, and so forth. And so the bank was sort of like the sibling of the car builders and the shipbuilders and airplane builders, or pick your industry. And so as corporate families, they were more comfortable making debt capital available to their industrial firms. So naturally, those firms used more debt capital than in the U.S., where we said a long time ago, we want a separation between banks and industrial corporations. Banks aren't allowed to own stock in industrial corporations, and there's an arm's length relationship that we think is best between financial institutions like banks and those industrial firms. So you know, the Japanese may use more debt, but they may use it for the wrong reasons. They too may not be maximizing firm value or minimizing cost of capital. They're just doing what comes naturally by having a bank as part of your family. It's like, you know, if you had an uncle who was president of a bank, you probably wouldn't have trouble getting a car loan, right? Same thing is true of Japanese companies, or at least historically has been anyway. So those were the key points or highlights that I thought I'd emphasize to you as you embark upon those chapters. So, you know, where we are, of course, we got those 2 chapters, and we got 2 more chapters after this, and that'll pretty much wrap up the envelope of what we've been able to cover in this rapid 7-week sprint. So, any questions, comments?
I don't think so.
Again, I keep emphasizing it, but I want, you know, don't get hung up for an inordinate amount of time on any of these things, whether it's cases, or homework problems, or just understanding something out of the text or the PowerPoint packages. You know, fire off an email to me, and I'll try to provide some amplification to it. I'm struggling a little bit to keep up with things this week, understandably. You know, yesterday was an offline day for me for the most part. I think actually in total. Well, actually, I was wrong. I was up early yesterday morning before we left Northern California and headed it. So I did do some work, and I was online early yesterday morning. And that's one of the advantages of having my my biological clock still in Eastern time. I'm up between 5 and 6 in the morning and say, well, I might as well get online and do some things for the next couple of hours. So shortly here, my 2 grandsons are going to be returning home from school. My daughter-in-law picked them up, and she and my wife are entertaining them somewhere to keep them away from here so I could get the session done. But these are the older grandsons of the ones. There's an 8-year-old and a 6-year-old, I guess, here. So these poor kids have just made their most recent move as they moved from Texas to here back in July. So
Oh, wow.
they've had to reacclimate. They were in Houston. The oldest of these two, started out his life in Virginia, spent 2 years in Belgium, 4 years in Houston, 2 years in Dallas, and now here in California. So
Wow.
it's not easy on the kids.
Yeah.
But they seem to be handling it well, and they seem to be in a good school setting, so that's the important thing. Anyway, any questions and comments, anything else? But, if you see that I've left a gap in instructions or materials that I've made available to you, or something I failed to post that you're expecting to be there, let me know, because it could easily happen. Things fall between the cracks. But I'm trying to stay on top of it. So.
Are we going to be meeting next Wednesday?
Oh, well, that was what we had agreed. Three of us at least agreed upon. I don't think I had surveyed Emma, and I'd hoped that she was going to join us tonight, so I could check with her and see what her thinking was on that. But I guess I'll fire an email off to her after this session and see. But if that still works best for you of any of the other time slots, let's plan on that, and I'll let her know that we're going to be doing that.
It's good for me. I'm planning on it.
Okay.
Yeah, it's good for me.
All right.
And did we say 6:30, same time, just a different night?
Yeah, if you wanted to make it 6 o'clock, would that be better? I could do that, but if 6:30 is fine, we'll leave it at that.
I'm okay with 6:30. I could go either way. It doesn't matter to me.
Let's leave it at 6. Let's leave it at 6:30 then,
Okay. All right.
just so that we don't confuse ourselves. But I'll fire an email to her and let her know what our plans are. Okay?
Okay. Well, enjoy your time with your grandchildren, and I hope you have a great trip.
Well, thus far it's worked out really well. The flights out worked, and we had a bit of a squeeze on our connection in Atlanta, but we made the flight, which is the only thing that's important. And then, so if it works as well going back, I'll be happy, because I generally don't like traveling these days, especially airline travel. It's just become too much of a hassle.
Yeah.
But what are you gonna do? You can't drive out here very easily, so we'll do it. Okay, ladies, we'll talk again, if not before. We'll do it next Wednesday, and stay in touch. Okay.
Okay. Thanks, Earl.
Thank you.
Thank
See you, Maureen.
Bye.